Bismillahirrahmanirrahim. Welcome to my business educational platform. I hope you understood the previous concepts regarding introduction to business. Here is what the overview of the last lecture. In last lecture we discussed what is finance and its interrelated areas, financial management, and three important financial management decisions: goal of firm, then structure of modern corporation. Today we will discuss the role of management, organization of the financial management, and some other basic concepts regarding finance and the financial management. So, what is the role of management? Managers are the agents who work on the behalf of the principals. And who are the principals? Principals are the one who provide the financing to the firm. Management acts as an agent for the owners, shareholders of the firm. So, the principal have its own goals and the managers have to work in the best interest of the principal. If the manager don't work in the best interest of principal, then there will be the agency conflicts. So what are the agency conflicts? In order to avoid that agency conflict, we have a theory that is known as agency theory. It's given by Jensen and Mackling. He developed a theory of the firm based on agency theory. So it is the branch of economics relating to the behavior of principals and their agents. So it shows the behavior of the principals and the agents. So the principals have separate goals and the agents have separate goals. So if there will be the difference of the goals, then there will be the conflicts. So what managers have to do, managers have to work in the best interest of the principal. So in order to avoid that agency conflict, that is the theory was given by Jensen and Mackling. So agency theory covers the agency relationship, agency conflict, and agency cost. So what is the agency relationship? Agency relationship is the relationship between the principals and the agents. Principals must provide incentives so that management acts in the principal's best interest and then monitor results. So in order to avoid that conflicts, principals must provide incentives so that management acts in the principal's best interest and then monitor results. Incentive includes the stock options. The principals may provide stock options that we will provide that much shares, perquisites, and bonuses. So then there is another concept that is known as the social responsibility. So what is the social responsibility? The businesses operate in the society, so they earn from the society, so the businesses have taken into account the social responsibility. So as per the book, it defines the corporate social responsibility as it is the integration of businesses operations and values whereby the interest of all stakeholders including investors, customers, employees, the community and the environment are reflected in the company's policies and actions. So there should be certain policies regarding the welfare of its community. As the businesses earn from the society, so they have to work in the best interest of society as well. So wealth maximization does not preclude the firm from being socially responsible. Assume we view the firm as producing both private and social goods. Then shareholder wealth maximization remain the appropriate goal in governing the firm. So then we have the organization of the financial management and management's function. How is the hierarchy of the organization in the financial management? There exists the board of directors and they elect the president. There became the annual general elections or meetings. So the shareholders, the primary shareholders provide the votes in order to elect the president. Then upon that we have the vice president of operations, vice president of finance, and vice president of marketing. So the president can be the chief executive officer, CEO, or he may hire someone from the outside the organization. So board of the directors are the honors are ultimate honors of the company. Then upon that there is the functional areas and functional operations presidents, like vice president of operations, vice president of marketing, and vice president of finance. What we will do, we will only look for the vice president of finance in this course. So here is what the vice president of finance deals. It deals with the treasurer, or it also deals as a controller. It deals with the capital budgeting, cash management, credit management, dividend disbursement, financial analysis, planning, pension management, insurance, risk management, tax analysis. He also deals with the cost accounting, cost management, data processing, general ledger, government reporting, internal control, preparing financial statements, preparing budgets, preparing forecasts. So then we have the types of businesses. There exist the three types of businesses. It starts from the sole proprietorship, partnership, and the corporation. So basically, the concept of sole proprietorship is that there will be the only one owner who will be dealing with the overall businesses. So certainly, if there will be the one owner, there will be certain advantages from that, and there will be some disadvantages from that. So what will be the advantages from that? It will be the simplicity. The single owner will deal with the businesses. He will be dealing. He will be not dependent on any others, and there will be the low setup cost. There will be not much cost, and there will be the quick setup. He will be dealing with all the functions, and then there will be the single tax filling on the individual form. So what will be the disadvantages? It will be the unlimited liability, hard to raise additional capital. If there will be the one owner, he will only produce from his capacity, as there exists the scarcity of resources. Then there will be the transfer of ownership difficulties. So then we have the partnership. A partnership, when there exists more than two and less than 90 members of the businesses. So as per the book, it defines the partnership as a business firm in which two or more individuals act as owners. So certainly there will be the advantages from that, and there will be certain disadvantages from that. So we will discuss them in our next slide. But there exist also the two types of partnership that are known as general partnership and the limited partnership. So what is the general partnership? It All the partners have unlimited liability and are liable for all obligations of the partnership. So the businesses in partnership, if there is the general partnership, then there will be the unlimited liability, and in order to overcome that, the partnership have to sell its own assets in order to fulfill that unlimited liability. And then there will be the limited partnership. Limited partnership include limited partners have liability limited to their capital contribution into investors only. At least one general partner is required, and all general partners have unlimited liability. So what are the advantages from the partnership? It can be simply manufactured, or it can be simply made. Low setup cost, higher than the sole proprietorship. There will be the low setup cost, but it will be the higher than the sole proprietorship, as there will be more than two members, more than one members. Relatively quick setup. Its setup is very quick. We can build it easily. Limited liability for limited partners, and there will be the limited liability for the limited partners. There will be the unlimited. There, what are the disadvantages can be of unlimited liability for the general partner. Difficult to raise additional capital, but easier than the sole proprietorship. As there will be the more than one members, the funds can be easily generated, but it will be easier than the proprietorship, but it will be hard than the corporation. Transfer of ownership difficulties. It becomes very hard to whom the ownership may be transferred. So then we have the corporation. It's a business from legally separate from its owners. So it's for the businesses are for going concerns. They never stop. They have the indefinite life. An artificial entity that can own assets and incur liabilities. Business income is accounted for on the income tax from the corporations. So certainly there will be the advantages from the corporations and there will be the disadvantages from the corporation. So what are the advantages? It's a limited liability, it's easy transfer of ownership, unlimited life, as the businesses are made up for the going concern concept, easier to raise large quantities of capitals, as there will be the more partners from the car, car partnership. Then there, what are the disadvantages? This disadvantages can be of double taxation, more difficult to establish, more expensive to set up and maintain. Then we have the limited liability company. Generally, limited liability company will possess only the first two of the following four standards corporation characteristics, like limited liability, centralized management, unlimited life. In Pakistan, limited liability corporations are known as private companies that end with PVT, private limited, or limited. They should have at least of 1 million as their minimum paid up capital. So what are the advantages from the limited liability? It's limited liability eliminate double taxation, no restriction on number of type of owners, easier to raise capital, additional capital. It has a limited life. Disadvantages are the it has limited life, that if there will be the limited liability, it has the limited life. The businesses will not be the further going concern consumption basis. Then we have the financial environment. Businesses interact continually with financial market. Financial markets are the markets that are composed of all institutions and procedures for bringing buyers and sellers of financial instruments together. So basically, the simple definition of the market is where the buyers and sellers meet. It is not necessary that they should be meet in physically, but they can also meet digitally, as there are certain digital platforms available. So financial markets are composed of all institutions and procedures for bringing buyers and sellers of financial instruments together. The financial instruments can be the bonds or stocks or short-term treasury bills, extra. So that was all from today's lecture. I hope you understood all the basic concepts.